All right, folks, I'm going to continue on with the lecture so we can finally get out of here in over an hour, unfortunately. But anyway, it's not going to be too painful. You're going to learn something about the financial system, which you might not know, which is a good thing. It's practical info. All right, so we've been talking about the interest rate that's being set by the market for loanable funds. We talked about the demand side of that market, the supply side of the market, how it ultimately allocates the funds for investment. So savings equals investment, as we looked at, and then this hypothetical market model allows us to sort of figure out, well, how do those forces get the savings to the people that value them the most? And again, the market is setting a price, which is the nominal interest rate, the interest rate that is not adjusted for inflation. But we know that there is a real interest rate also. So then now we're going to examine this relationship between inflation and the interest rates. So arguably the most important factor affecting interest rates over time, changing expectations about future inflation. So that is the force that affects interest rates over time, like the expectations about changing inflation, what people think will happen with inflation. Are prices going to go up? Are prices going to go down? We know that the real interest rate is equal to the real interest rate. The real interest rate is equal to the nominal interest rate minus the rate of inflation. And so this is what people are ultimately interested in. And so this is going to tell us something about how people will react and therefore cause changes in the loanable funds market to affect the nominal interest rate. So again, the most important factor, this expectation about inflation, will shift both supply and demand for loanable funds. All right, so in the loanable funds model, we use the nominal interest rate because in the real world, neither borrowers nor lenders know what future inflation will actually be when they make a deal, but they try to sort of assess it based on signals that are coming from the economy. Is the economy looking like it's getting better, like it's heating up, like incomes are going up, the amount of output is going up? If that is the case, then prices will likely be going up, and therefore inflation will also be going up, and vice versa. All right, since we're holding expected future inflation fixed when we're looking at the loanable funds market, and therefore changes to the nominal interest rate, changes in the nominal interest rate also lead to changes in the real interest rate. All right, so the curves here, we've got the supply of loanable funds, the demand for loanable funds, again in equilibrium, quantity of funds that are borrowed, and an equilibrium interest rate. In this case, it's 4%. So again, we are holding the expected inflation rate constant, so then the only thing that could really affect the real interest rate is the nominal interest rate. All right, so the curves here, S naught and D naught, again, show the supply and demand for loanable funds given the expected future rate of inflation, 0%. So that's our starting point here. Our starting point is that nobody expects there to be any inflation. And therefore, the equilibrium real interest rate here over the life of this loan is 4%. The real interest rate is going to be, again, the nominal interest rate, 4%, minus the rate of inflation, which is 0. So the real interest rate will be 4% as it stands in the state of the model. Now we're going to suppose that the expected future inflation rate rises to 10%. All of a sudden, things are happening. Maybe the internet's been created and now all sorts of new business opportunities exist, which means that people are going to start buying a bunch of stuff and there's going to be a lot more production, which means that prices will go up, which means people expect there to be 10% inflation over the next year, let's say. So now I'm going to demonstrate how that's going to affect both the supply and the demand in the loanable funds market. And that will actually get us to a nominal interest rate that will then get us to the real interest rate that we would expect given the new expectation of inflation. All right, so borrowers are now willing to borrow as much at a nominal interest rate of 14% as they were previously willing to borrow at 14% because they expect there to be inflation Their real concern is how much is the real rate of return on their investments, right? The real rate of return being the difference between the nominal and the inflation rate. And so if they expect there to be 10% inflation, then what we expect is that the demand curve in the loanable funds market will shift up to the point where the new point of equilibrium will be at 14%. So at any given interest rate, what this is telling us is that folks are willing to borrow more. Similarly, lenders require a nominal interest rate of 14% to persuade them to lend as much as they would previously have lent at 4%. So again, knowing that inflation is going to go up to 10%, lenders are interested in the real rate of return, the inflation adjusted return on investments, which again is the real interest rate. And so if you have a 4% interest rate, then they're going to want 14% on their existing loans in order to make them profitable. And so therefore, at the old quantity of loans that are being lent out, they're going to demand 14%, and that's going to shift the entire supply curve up again to this point, S10, which will get us to this new equilibrium point, which corresponds to the nominal interest rate of 14%. So the result of an expected future inflation rate of 10% is that the equilibrium nominal interest rate rises from 4% to 14%. This is what's called the Fisher effect. The Fisher effect says that an increase in the expected future inflation rate drives up the nominal interest rate, leaving the expected real interest rate unchanged. So remember, the real interest rate is the difference between the nominal and the inflation rate. Originally, we had 4% real interest rate, which was again the difference between the 4% nominal and 0% inflation at this point here. Then everybody expected inflation to go up by 10%. In order to maintain the real interest rate at 4%, the nominal interest rate had to go up to 14% because 14 minus 10 is equal to 4, leaving the real interest rate unchanged, which is what the Fisher effect is. So as a result, a change in the expected rate of inflation does not affect the equilibrium quantity of loanable funds or the expected real interest rate, only the equilibrium nominal interest rate. All right, just really quick, let's look at 60 years of U.S. interest rates here. So we've got changes in expected inflation and the interest rate. So we see that from 1953 to the present, that there are very similar movements in both the inflation rate and in this case, we're looking at the 10-year Treasury constant maturity rate. We'll talk about later what those Treasury bonds are and how they work. But for now, just think of it as like that interest rate that is equilibrated in the loanable funds market. And we see that as inflation is moving up and down, that the nominal interest rate is also moving along with it in a very similar pattern that, again, is capturing this Fisher effect in which people are, again, reacting to the real interest rate rather than the nominal interest rate. And thus, things that are changing in the loanable funds market are keeping the real interest rate steady. Over here we have changes in the expected rate of return on investment spending and interest rate. So here's the 10-year constant maturity rate. So again, this is like basically the interest rate and what it's been doing over the last, in this case, 12 years. And we see that the interest rate was going up during the housing boom. And again, that is because of that rightward shift of the supply of loanable funds due to an increase in net capital inflows, due to the increase borrowing that we were doing from like China and other countries. And then we had the housing bust, which caused the amount of investment to decrease, and therefore the demand for the loanable funds to decrease, the demand being the downward sloping one, so then it brought down the interest rate during that period. All right, so that's investment savings. That's how they're allocated in sort of this like abstract, weird like model that does capture like a lot of the patterns that we see in the macroeconomy, but doesn't necessarily represent an actual market because there's so many markets that are being sort of captured together in this one simplified model. But that's what economics is. Economics is about simplification and understanding like big forces as much as possible with like the simplest tools possible. And this approach has changed the world, has allowed us to have more stability in the world, not having as many ups and downs in our overall business cycle as we used to have in the past. And so it's very powerful, but one can always call into question like the simplified nature of the tools we use, and that's where a lot of the points of contention occur in the big debates over macro policy that's based on like this kind of analysis, because you can always kind of like attack the cracks in the assumptions that are made to get us to the models. But when you compare like the behavior of the models to like patterns of the data like we just did, there are patterns that can be explained with the models, and therefore those are like sort of the counter arguments to the criticisms. All right, anyway, so let's talk about the financial system now, learn a little bit about the various assets that exist and some of the financial institutions that help to channel savings into investment. So most economies have some sort of financial system to handle household wealth and make loans. So wealth in economics is defined as the value of a household's accumulated savings. A financial asset is a paper claim that entitles the buyer to future income from the seller. A physical asset is something tangible, something that you can hold, that can be used to generate future income. So like a company's assembly line, like an automated assembly line, is a physical asset that can generate future income. So if you purchase a pre-existing piece of equipment, say a used airliner, you are investing in a physical asset. If you spend funds that add to the stock of physical capital in the economy, like let's say purchasing newly manufactured airplanes, you're engaging in investment spending. If you get a loan from your local bank, maybe to buy a new car, you and the bank are creating a financial asset, which is your loan. So the loan is a claim that entitles the buyer to future income from the seller. So essentially, you borrow money and you are then expected to pay money back to the bank. And so the bank is basically buying this claim from you, and you're promising to pay back money on top of what you originally borrowed in interest to get that claim back. Liability. A liability is a requirement to pay income in the future. So although your loan is a financial asset from the bank's point of view, it's a liability from your point of view. So it depends on who's holding the asset, the nature of what it's ultimately going to wind up meaning to the holder. And this definition of either an asset to one party or a liability to another is going to play a big part in us understanding the banking system and ultimately understanding how money is created. And that's going to be post a second exam, but something to keep in mind. So there's four principal types of financial assets. There's stocks, there's bonds, there's loans, and there are bank deposits. So let's consider them in turn. Since a financial asset is a claim to future income that someone has to pay, it's also somebody else's liability. They exist because the economy has developed a set of specialized markets like the stock market and the bond markets, and specialized institutions like banks that facilitate the flows of funds from lenders to borrowers. All right, let's talk about the three tasks of the financial system. The financial system's first task is to reduce transaction costs. Transaction costs are the expenses of negotiating and executing a deal. So arranging a loan requires spending time and money negotiating the terms of the deal, verifying the borrower's ability to pay, drawing up and executing legal documents, etc. When large businesses want to borrow money, they either go to a bank or they sell bonds in the bond market. So if you're selling a bond in the bond market, you're basically selling a promise to pay back. So if you buy a bond from somebody, you're basically lending them money. And so you have the asset and they have the liability. They have the liability, which is like that they have to pay you back. All right, so what this whole process does is to consolidate transactions and minimize costs. All right, so the second purpose of the financial system is to reduce risk. So financial risk is uncertainty about future outcomes that involve financial losses or gains. So most people view potential losses and gains in an asymmetrical way. They don't view them equivalently. Losing a given amount of money is generally experienced more intensely than they experience the increase in welfare from gaining the same amount of money. So if you get $1 from somebody, that's not going to give you as much pleasure as losing $1 will hurt you. In general, on average, amongst most people, that's the effect. People feel more hurt by the loss of the same money that maybe they gain than the amount of what we call utility satisfaction from gaining the money. So the loss is worse than the gain generally. A person who's more sensitive to a loss than to a gain of an equal dollar amount is called risk averse. A risk averse business owner that wants to take on a risky investment, instead of using her money, can sell shares of her business. So by selling shares of her business, then she doesn't have to spend her own money on the investment, and therefore she does what's called diversify the risk. By selling a share of her business, the owner has achieved diversification. Diversification, formally defined, means investing in several different things so that the possible losses are independent events. That's what are called hedge funds. That's what they do. They spread out the risk by investing people's money in a variety of different assets, therefore making the risk independent of each other, and on average, ideally, having some sort of positive return, even though sometimes it fails if things are bad overall in the economy. But diversification is definitely the best strategy if you want to kind of gamble in these markets. All right, so the third purpose of the financial system is to provide liquidity. The financial system also exists to provide investors with liquidity, a concern that, like risk, arises from the uncertain future. So what it means for something to be liquid, it means that an asset can be quickly converted into cash with relatively little loss of value. That's what it means to be liquid. So if you have a lot of money tied up in a bunch of investments that are long-term, that you can get your money out of, then that is an illiquid asset. So an illiquid asset is an asset that cannot be quickly converted into cash with relatively little loss of value. So there's usually going to be some big penalty for trying to take money out of an illiquid asset, which will severely lower the value of the asset. And therefore people don't like to do it, and therefore it's difficult to convert those types of illiquid assets to money. So they are illiquid. All right, let's talk about the four types of financial assets. So again, one is a loan. A loan is a lending agreement between an individual lender and an individual borrower, which you all know. So the good aspect of loans is that a given loan is usually tailored to the needs of the borrower. The bad aspect of loans is that making a loan to an individual person or a business typically involves a lot of transaction costs. Right? You got to find out if the person is creditworthy. You got to maybe dig up a bunch of documents that establish their income, their previous credit history, maybe a history of their investments. So to minimize these costs, large borrowers take a more streamlined approach. They sell or issue what are called bonds. So loans are liability to the borrower and an asset to the lender. So if the bank is letting you borrow money for a car, then for you, that's a liability. You have to pay that money back with interest. For the bank, it's an asset. The asset is a promise to pay them. So regardless of the fact that they don't have the money currently and that it will take, the specified time of the loan to get the money back, the maturity, eventually that money will come to them. And so how they value a loan as an asset is they'll take the present value of like that income stream over time. And so present value plays a huge role in like the valuing of assets. And it's something that you should understand. Even if you don't wind up going into business, it's important to understand what we call the time value of money, the present value of money. All right, the second asset, bonds. Again, like to avoid the transaction costs of making loans, financial institutions or even governments issue what are called bonds as a way of borrowing money. So bonds are IOUs issued by the borrower. A bond is a financial asset from its owner's point of view and a liability from its issuer's point of view. A bond issuer sells a number of bonds with a given interest rate and maturity date to whoever is willing to buy them. A concern for the buyer is the possibility of a default. So, there's a possibility that maybe even a government might not be able to pay back their bonds. Generally, that's not the case with governments that are stable, but you never know. With us, a couple of years ago when we were having trouble raising what was called the debt ceiling, our ability to, run a deficit, like it's something that has to be greenlit by Congress. And it's something that's pretty standard, but the Republicans were playing hardball with Obama and they were just creating all sorts of chaos. That caused the bond rating agencies, which are the agencies that rate the risk of these financial instruments, to actually downgrade our credit rating with respect to our bonds, basically saying that our bonds are a little bit more risky than they used to be, and there's a little bit more of a possibility that we actually will not be able to pay on our bonds because we weren't able to raise the debt ceiling. It was obviously a lot of posturing on the part of Republicans, and ultimately they gave in and the debt ceiling was raised, but the harm had been done. So there is always a possibility of a default. A default occurs when a borrower fails to make payments as specified by the loan or a bond contract. Puerto Rico recently defaulted on some bonds. So there was like this whole thing, because Puerto Rico is like this weird sort of place because it is part of the US, right? But it's called a territory. It's not a state. And so it's a really unfortunate situation. Like they even have like a representative in Congress, but the representative cannot vote. And so normally when like one of our states has problems with bonds and maybe potentially not being able to pay them back, they're helped out by the federal government. But because the Puerto Rico is like a territory, like the same rules don't apply to them. And so there was just all this kind of like back and forth, like trying to figure out what can we do to sort of like, create a different set of conditions which will allow the federal government to help bail out Puerto Rico. And we weren't able to push it through. And Obama, I think, wanted to do something about it, but there was a lot of resistance in Congress, and so nothing was done. And so Puerto Rico wound up defaulting on some of their bonds, which is highly problematic, because if a country or like a state or any kind of government body defaults on bonds, then it can be disastrous for like the people of that area, right? Because the government needs to fund whatever they're funding to make sure that things are running properly, right? Like police departments, social services, etc. So it's a really unfortunate situation, and we should have helped Puerto Rico is what I'm trying to say here. But anyway, defaults occur. So once a bond's risk of default has been rated by these credit rating agencies that occur, Moody's is one of them, Barclays is another, there's a couple others. It can be sold on the bond market as a more or less standardized product. So there are markets where bonds are bought and sold. So you don't just issue a bond and you sell it to somebody and that's it. Whoever owns the bond, which again is an asset, can then go and resell it to somebody else. So obviously there's a lot of that going on. So another important advantage of bonds is that they're easy to resell. They are generally considered pretty safe assets. And the way things work as far as like the pricing, on assets is like the safer they are, the lower the price, because the more risk there is involved in an asset, then the more that a borrower needs to pay an interest. And so generally with bonds, there's a very low likelihood that people will default regardless of what the institution is that's issuing the bonds. And therefore, the risk is low, so therefore the returns are low also. Loans, in contrast to bonds, so loans themselves, like an auto loan or a home loan, are much more difficult to resell because unlike bonds, they are not standardized. They differ in size, quality, terms, etc. So with bonds, it's like a government might issue like, a million bonds, and they're all the same. It's all pretty like clear cut, like what the asset is, what it represents, what the interest rate is, what the risk is. It's very clear. But when you start trying to like create more value out of assets that are not necessarily created to be these sort of like financial assets, like maybe home loans, then it starts to become problematic because it becomes unclear the nature of the actual asset, how risky the actual asset is. And that is actually what led to the big crash of 2008, which I'll get more into as we move forward. So you have what's called these loan-backed securities. So loan-backed securities are assets created by pooling individual loans and selling shares in that pool. The process of creating these is called securitization. These loan-backed securities are traded on financial markets like bonds. They're preferred by investors because they provide more diversification and liquidity than individual loans. So many loans packaged together, with so many loans packaged together, it can be difficult to assess the true quality of the asset. So this is what happened pre-2008. A lot of mortgages were tied up into these loan-backed securities. They were called CDOs, collateralized debt obligations. And so you had a lot of banks that were holding these CDOs as assets. And the problem was that during that time period, there were a lot of what was called subprime lending going on, in which like people that weren't necessarily in a position to borrow large amounts of money to buy homes, like were being given loans, and there were like no document loans. There was a lot of like funny business going on in the back of these like loan originators, just trying to get as many loans through as possible, and basically letting a lot slide with respect to ability to pay back. And so you had a lot. And so what a lot of these firms would do is like they weren't even actually meant to be banks that give mortgage loans. They were just created for the purpose of creating home loans that can then be securitized and then sold on the security markets for these loan-backed securities. And so then you had a bunch of these like really bad assets that were piled together, and diversifying the risk, which is a good thing, but there was just too much risk there, and it just wasn't transparent enough. There were so many of these assets, and nobody was actually looking at the documents that were backing up these assets, like the fact that people that had these homes were probably going to end up defaulting on their loans. And so that's what happened. Like between like 2006 and 2007, like a lot of these people that borrowed all this money to buy these homes started defaulting on their loans. And so because you had this huge wave of defaults, you had all of these assets start to be worth nothing. And because a lot of the banks had like wound up taking a lot of these assets as what's called capital requirements, like they have to have a certain amount of assets, like all of a sudden, like what they have to sort of back up like their ability to lend and borrow, their ability to pay back savers, started to evaporate. And all of a sudden, all these banks, like it became very shaky. Like, can they pay back their borrowers? And so we started having what are called bank runs, which we'll talk about more later in the banking chapters. But a lot of people started to get nervous and started to want to take their money out of banks. And so we had a lot of banks start to fail, really big banks that have been around for like a couple 100 years type of banks. And that's when things just started to implode. And it really all came down to these securitized debt obligations that were wrapping up home loans that were horrible, that were just atrocious. But again, like the diversification that came with the securitization sort of masked the risk that was very huge and ultimately led to the decline and the potential collapse of our entire economy. Fortunately, the government stepped in and did some pretty ugly things. The nearly $1 trillion bailout of the banks was part of that. That was meant to get money into banks so that people weren't nervous about banks going under. That's what that money was for. And so, yeah, there was a lot of controversy with respect to should the government be doing this? Like, should we be giving banks this money? Like, they're the ones that took on the risk. Like, like, shouldn't we just let them fail and then just let them learn their lesson? That was like a big argument that was going on. But on the other side of it, it's like, well, you let them fail, our financial system collapses, and then everybody's screwed. And during that time, like, banks stopped lending. So, like, firms couldn't borrow money to continue their operations. It was just a disaster. I don't know how many of you, like, were old enough to, like, really be aware of what was going on. But I'm sure you have a memory of, like, what was going on during that time, 2008. It was like it was a chaotic time, but it was super interesting as well because it's like, whoa, what's going to happen next? But what could happen next was like disaster, so that was scary. But super crazy time. I don't know if you don't remember it. Maybe like go back and try to. There's all sorts of documentaries that cover the period that are worth watching, and just kind of like understanding like how fragile like our world is. Like there's any small things that come to light like this huge amount of these securitized assets that are worth nothing, like could bring down the system. And so we need regulation to stop banks from, doing these sorts of things. But of course, there's always like resistance to that because there's this whole like propensity to like want government to step away from markets and not be involved, which makes sense to some extent, but also it doesn't make sense. So it's just, economics is an exciting field, folks. I recommend it, really. I do recommend it. It's a tough field because you got to learn a lot of stuff. You got to learn a lot of math. You got to learn statistics. You got to learn all this stuff. But in the end, like, it's a really exciting area of the world, and it's worth your time. Let's continue on here. All right, so the fourth asset is stocks. So again, we have loans, we have bonds, we have loan-backed securities, and now we have stocks. Stocks are a share in the ownership of a company, right? So it's basically a claim on their profit stream. So we know that firms have a certain amount of assets and a certain amount of contracts that yield a certain amount of profits over a given amount of time, which, again, using present value gives us the present value of the firm, and we, by owning a stock in that firm, have a claim to some of those profits. So the good aspect of loans in general is that a given loan is usually tailored to the needs of the borrower. A share of stock, though, is a financial asset from its owner's point of view and a liability from the company's point of view. Privately held companies do not sell stock, so only publicly held companies sell stock. So you might have a company that starts up first and then they get pretty big. So a lot of like the large internet firms, the large sort of app firms like Twitter and all these, and Facebook and Instagram, etc. Like they all started out as private companies, and then at some point they did what's called an IPO, an initial public offering, and that's when they go public, right? So that's when they sell a bunch of their stock, and then people buy, and then all of a sudden it becomes a publicly traded company, and so that's when the transition happens. But you do generally start with a private company that's just started by an owner that maybe gets some investors, and they get the company going, and then once it becomes big enough, that's when it becomes public. So a company like eBay is obviously one of these public companies. Most large companies sell stocks to diversify their risk. The downside of owning stocks of a given company is that it's riskier than owning a bond issued by the same company. So a bond will generally be paid back, but a stock can be shaky because a stock is a claim on profits, and if there's no profits, then there's nothing there. And so stocks are definitely riskier assets, but they can also, because they're riskier, they wind up giving you a bigger return if they wind up um, yielding some sort of high positive profit, and the form that those profits take is called the dividends. So if they have profits above a certain threshold, then they'll usually divide them up amongst all stockholders and send them out. So you'll get payments from your ownership of stocks, which is above, which is on top of the value of the actual stock certificate that you can also sell. So again, the added risk generally comes with a higher return than a bond. All right, now let's talk about the financial intermediaries, the institutions that help to channel savings to investment. So a financial intermediary is an institution that transforms the funds it gathers from many individuals into financial assets. So the first financial intermediary we consider is called a mutual fund. You've heard of these funds. So stock investors can lower their total risk by owning a diversified portfolio of stocks. For individuals who don't have a large amount of money to invest in a diversified stock portfolio, they can usually incur high transaction costs, because in order to buy and sell stocks, you usually have to pay some money. You have to pay money to buy a stock. You have to pay money to sell a stock. So then we've got with these things called mutual funds that help to lower these transaction costs. So mutual funds are a financial intermediary that creates a stock portfolio and then resells shares of this portfolio to individual investors. So you, as an individual investor who maybe is not a large investor but wants to invest in the stock market and doesn't want to incur the high transaction costs, will invest in a mutual fund that is doing that for you. They are investing in a variety of assets, and they are diversifying the risk, and you get a return on their overall investments. U.S. mutual funds had assets of $15 trillion at the end of 2003, so they're pretty big investors. There are, of course, fees involved in mutual funds that vary with the level of precision in investment choices, but generally it is a good deal with respect to wanting to enter these. Ultimately, what are games, like gambling games, because that's what investing is. All right, we've also got other financial intermediaries, such as pension funds and life insurance companies. So you don't often think of like a life insurance company as like a big financial intermediary, but you have to think about like a lot of people having a lot of money in these companies that are promising to pay out if people die, but generally you're not going to get that many deaths. You're just going to get a lot of people that are risk averse, that are afraid of death and loss, and so will pay into insurance companies, and so insurance companies have to pay out a lot less than they're getting in, and thus the excess funds they have are invested, and they become big investors. Pension funds are like funds like retirement funds. So I pay into a pension, like the California pension fund, as a professor at a public university, and most public workers pay into those funds. Private companies have their own like investment funds for pensions. So any kind of pension fund is going to have a huge pool of money, and generally they are going to invest that money to try to get a return on it. So a pension fund is a type of mutual fund that holds assets in order to provide retirement income to its members. Although pension funds are subject to some special rules and receive special treatment for tax purposes, they function much like mutual funds. Life insurance companies sell policies that guarantee a payment to a policyholder's beneficiaries when the policyholder dies, as you know. By enabling policyholders to cushion their beneficiaries from financial hardship arising from their death, life insurance companies also improve welfare by reducing risk. So Social Security, the payments that the government makes to the retired individuals in our society, is also a pension fund, but it's a public pension fund. And sometimes you'll hear about this movement by certain groups in our society that are looking to privatize Social Security. They want to make it into a private fund. If you ever hear about this, like it's important to have an opinion on the issue, of course, and you should inform yourself as much as possible. But to be honest, like it's a bad idea for Social Security to become privatized because um, sometimes pension funds fail. You know, like they will put money out into a variety of investments, and if those investments are too risky, they won't get a good return, and sometimes they go under. And we can't have like a public fund like Social Security that's meant to secure like our old people, the people that are not working, that are, you know, they need to be taken care of. We can't have something like that, this social safety net, like be compromised. And it will be compromised. Yes, the possibility of having a higher return and thus having greater funds in Social Security as a result of privatization does exist. But the extra risk of maybe eventually not being able to pay out any Social Security to anybody is just not worth it. It's just not worth like the extra potential return that can be gotten from privatizing it. So it's a bad idea in general. That's just my opinion. All right, another financial intermediary, of course, is just your standard bank. So recall the problem of liquidity. Other things equal, people want assets that can easily be converted into cash. People want liquid assets. Bonds and stocks are much more liquid than physical assets or loans. Yet the transaction cost of selling bonds or stocks to meet a sudden expense can be large. So stocks and bonds are not as liquid as other assets that we will define later in the banking, money and banking chapter. So for many small and moderately sized companies, the cost of issuing bonds and stocks is also too large, given the modest amount of money they seek to raise. A bank is an institution that helps to resolve the conflict between lenders' needs for liquidity and the financing needs of borrowers who don't want to use the stock or bonds market. So banks are the financial intermediaries that facilitate liquidity the most out of all the financial intermediaries that we consider and exist in our financial system. A bank works by first accepting funds from depositors, as you know. When you put your money in a bank, you're essentially becoming a lender. So a bank deposit, just formally defined, is a claim on a bank that obliges the bank to give the depositor his or her cash when demanded. So a bank deposit is a financial asset owned by the depositor and a liability of the bank that holds it. So any savings accounts that you guys have at banks are liabilities to the bank and assets to you. A bank, though, keeps only a fraction of its customers' deposits in the form of ready cash, lending out the rest. So that function that the bank serves and the way that it goes about serving it plays a huge role in the creation of money in our financial system, which again is something that will be covered in the last part of the course. But again, like banks function on this principle that like not everybody's going to want to take their money out at the same time. And so there is always going to be this pool of excess savings available to them to lend out. And they do lend it out, of course. So again, a bank is a financial intermediary that provides liquid assets in the form of bank deposits to lenders and uses those funds to finance the illiquid investment spending needs of borrowers. All right, so the bank counts on the fact that on average, only a small fraction of its depositors will want their cash at the same time. If a bank becomes financially incapable of paying its depositors, individual bank deposits are guaranteed to depositors up to $250,000 by what's called the Federal Deposit Insurance Corporation, or the FDIC, you might have heard of it, which is a federal agency. So in 2008, when some of the banks were going under, the FDIC actually did step in and pay out some money, but it became like a pretty precarious situation, a very bad situation with respect to this whole type of insurance, because there was a possibility that if enough banks went under, that the Federal Deposit Insurance Corporation itself would become illiquid, would become insolvent and not be able to pay out to everybody. So there were like emergency measures taken. I believe that the limit on the Federal Deposit Insurance was raised temporarily during that time period, and so the bailout was also intended to protect the possibility of the FDIC failing and ultimately our entire banking system failing, which was a very real possibility at that time. Was there a question? Okay. But under normal conditions, bank need only hold a fraction of their depositors' cash because the threat of too many people asking for their money back is very small generally. In 2008, it was huge. All right, so let's just quickly talk about the relationship between some of the fluctuations in these asset prices and the fluctuations in the overall economy. So we've learned that the financial system is an essential part of the economy, given that without stock markets, banks, long-run economic growth would be hard to achieve. The financial system sometimes doesn't function well and instead is a source of instability in the short run. So the focus here is on the cause of asset price fluctuations. Like, why do the prices of assets themselves fluctuate? So let's talk about the demand for stocks. So unlike a good or a service whose value to its owner comes from its consumption, the value of an asset comes from its ability to generate higher future consumption of goods and services in the form of profits, in the form of future income streams. So stock prices are determined by supply and demand for shares, which in turn depend on investors' expectations about future stock prices. Stock prices are also affected by changes in the attractiveness of substitute assets like bonds. So if bonds start to give bigger returns, then people are going to substitute away from stocks to bonds. All right, let's talk about what affects the demand for other assets. So beliefs and the price of substitutes have the same effect on all assets, including physical assets, as the effects that they have on stocks. So beliefs are a huge part of like the pricing of financial assets, which is a huge part of financing in general. So if you go into the finance major, this is sort of an important theme that is always explored in like the theory of pricing assets. Like, there is always some uncertainty with respect to the future. There is always uncertainty with respect to the forces that will determine the prices of assets. And so because there is that, you need to incorporate that into your models that price assets. And so how you do that is you incorporate what's called probability into it. So you'll set up like this mathematical relationship between different possible outcomes that then gives you sort of an average idea of what could happen. And so that's part of what makes finance and economics challenging fields, because we're always trying to sort of control for the uncertainty by trying to sort of incorporate these probable forces into our models. And that's ultimately impossible, because the things that drive the uncertainty are the things that drive us human beings, which is what John Maynard Keynes, one of the architects of macroeconomics, termed animal spirit. So all of us have like this animal spirit side to us, this part that doesn't always follow the logic, right? Like, we know what we should be doing, but sometimes we do something completely different. And so if you take, everybody in the economy that has these animal spirits within them, that creates a lot of uncertainty with respect to what they'll ultimately do. We know what they should do given, the nature of the system they exist in and the kind of incentives that exist, which give us an indication of what they will do. But in the end, like, what they actually wind up doing has a lot to do with, like, what their animal spirits are going to guide them to do. And so, again, to try to have any kind of like control of the chaos that is the uncertainty around like the financial system and the economy, like, you have to incorporate uncertainty into your models. And that's what makes this discipline and those related to it challenging, because it's not just understanding like the things that I'm explaining here in this course, because the things that are explained in introductory micro and introductory macro is just like the foundations of your understanding of this discipline and the related disciplines like finance. Because once you've covered all this stuff, and you've seen the books, they're not that fat, so it's not like a lot. There aren't a lot of ideas. Once you understand those basic ideas, then you have to build on those ideas by then bringing in mathematics, by bringing in statistics, by bringing in probability. And that is what complicates these disciplines. And that is what makes them ultimately very valuable in society, because they're challenging to master. But if you do master them, you become one of the few that do in the world, and therefore you create a lot of value inside of yourself. So it's worth your time to understand these things. And even if you just wind up understanding these things on the level that this class expects you to understand them, it's still a very valuable set of information because it is very practical. It helps you to maneuver your way in the world. But you do have to understand that the uncertainty in the world complicates the discipline, and therefore will make it a challenging road for you if you want to move forward in finance, if you want to move forward in economics, and even in business in general, because there's a lot of uncertainty in business as well. And a lot of these tools help to understand how to best maneuver within the business arena as well. So you have to prepare yourself mentally for bigger challenges to come. But definitely be as plugged in as possible into this course and maybe your other introductory courses to get the foundations down, so that when you are then faced with the challenges of learning the tools that we use to really try to master these aspects of our world, this stuff is already part of kind of like your matrix of understanding. It's like you got it, and then you can build from it. All right, so again, what got me talking about that was the fact that there are beliefs that play a huge role in the determination of asset prices. So again, here we're talking about the demand for other assets beyond stocks. And so if you think about the price of substitutes for those assets, other places that people can invest their money, that will have a big effect on the price of an asset. Houses are one asset that Americans most commonly own. To a large extent, the benefit of owning your home is the fact that you don't have to pay rent to someone else. Or to put it differently, it's as if you were paying rent to yourself. The U.S. government actually includes this as what's called implicit rent in their estimates of GDP. The amount people are willing to pay for a house depends in part on the implicit rent they expect to receive from that house. The interest rate also has an effect on housing demand. All right. So let's talk about asset price expectations, like the nature of the beliefs in what may happen to prices. So there are two principal competing views about how asset price expectations are determined. One view comes from the traditional economic analysis that emphasizes rational reasons why expectations should change. And the other belief widely held by market participants and also supported by some economists, emphasizing the irrationality of market participants. So we have what's called the efficient markets hypothesis, and that sort of reflects a more rational approach to understanding the nature of beliefs and their role in pricing of assets. So the efficient market hypothesis says that asset prices embodies all public available information. So any asset price already has all information already factored into its price. So if you think that you have some information that's going to help you to be able to understand how the price of an asset might change, the reality is that the asset price has already embodied that change in its price already. So one implication of the efficient market hypothesis is that at any point in time, stock prices are fairly valued. They reflect all current available information about the fundamentals, the fundamental underlying value of the asset. So the idea is that they are neither overpriced nor underpriced. Another implication of the efficient markets hypothesis is that the prices of stocks and other assets should change only in response to new information about the underlying fundamentals. Since new information is by definition unpredictable, we have what's called a random walk. A random walk is the movement over time of an unpredictable variable. So again, because the information about what may happen is just uncertain and you don't know where it's going to go, then you basically have to reconcile the fact that that information is something that you cannot predict, and therefore accept the fact that it will always be random. It is a random walk. So most investment professionals and many economists, however, regard it as an oversimplification because they say that investors are not that rational. So this is like the most rational way of viewing how asset prices might fluctuate in respect to beliefs, with respect to beliefs. But again, like there is a very, very prominent understanding of the fact that animal spirits exist and they do play a role in the way that assets might behave. And so then we have what are called irrational markets, the second approach. So many traders believe that markets often behave irrationally and that a smart investor can engage in successful market timing, buying stocks when they are underpriced and selling them when they are overpriced. Although economists are generally skeptical about claims that there are surefire ways to outsmart the market, many have also challenged the efficient markets hypothesis. Serious challenges to the efficient market hypothesis focus instead either on evidence of systematic misbehavior of market prices or on evidence that individual investors don't behave in the way that the theory suggests. So the idea is that, like, although we can assume that things are working the way they're supposed to be working, the animal spirits would tell us that people are just acting crazy, basically. And because people are acting crazy in general, there's always that element in the pricing of assets that you can therefore find assets that are underpriced or overpriced, and therefore you can make a return. Others believe that they have strong evidence that individual investors behave in systematically irrational ways. So others believe that you can actually figure out the system of craziness that people sort of engage in their investing behavior. So people seem to expect that a stock that has risen in the past will keep on rising, even though the efficient market hypothesis tells us that there's no reason to expect this. So again, like, animal spirits guide people to think things that maybe are not necessarily logical, but then that might actually create a situation in which you can actually then predict what might actually happen to asset prices by incorporating that understanding of that craziness into your models of predicting prices. So it's a really tricky sort of process. All right, so how do these fluctuations in asset prices relate to the macroeconomy? So how macroeconomists and policymakers should deal with the fact that asset prices fluctuate a lot and that these fluctuations can have important economic effects is a big topic in macroeconomics. On one side, policymakers are reluctant to assume that the market is wrong, that asset prices are either too high or too low. It's hard to make the case that government officials are better judges of appropriate prices than private investors. On the other side, the past 20 years were marked by not one but two huge asset bubbles, each of which created major macroeconomic problems when they burst. We'll get into these later in the semester. These events have prompted much debate over whether and how to limit financial instability. So again, in 2008 is when the big housing bubble burst, and it was, again, due to the fact that there was this sort of irrational belief that housing prices would continue to increase forever. And that went on for quite a bit. But then when it became evident that the assets were actually not valued in the way that we thought, and people started to default on their loans, and banks started to go under, we had this housing bust, and the pricing of the assets burst. And of course, that wound up creating huge instability in the actual economy, right? The worldwide macroeconomy, the ability of countries to produce, the flow of income from producers to households. So there is a huge link between what is happening with respect to the irrationality of asset prices and what happens in the overall economy. And again, like I mentioned, it's a huge topic in macro, and it's just one of those things that we'll never truly master, because you can't master, because people will behave in crazy ways, in ways that you cannot predict, and it will create situations like we had in 2008. Even though every institution that we have in our economy is trying to stop it, like we won't be able to, and things will happen again of this magnitude, maybe worse. And that's just the reality of the world we live in. But you need a certain set of tools. You need as much control over the situation as you can get. And that's where the power of our discipline comes in. And that's why it is important to, even though we acknowledge that there is a lot of uncertainty and maybe that uncertainty is ultimately unpredictable, it's important for us to try to predict it. It's important for us to try to incorporate the uncertainty into our models in order to create as much stability as possible, even though, in the end, like, we do wind up in situations like this no matter what we do. All right, let's do a quick practice problem just to remember the Fisher effect and its importance. So suppose that the expected inflation rises from 3% to 6%. How will the real interest rate be affected by this change? Unchanged, exactly. Because the Fisher effect will tell us that the nominal interest rate will change, right, to keep the real interest rate at the same level. So again, the real interest rate equals the nominal interest rate minus the inflation rate. So the answer is that the real rate will not change. According to the Fisher effect, an increase in the expected inflation drives up the nominal interest rate, leaving the real interest rate unchanged. How will the nominal interest rate be affected by this change? Increase 3%, right? It would increase 3% because inflation went up by 3%, right? So to keep the real interest rate the same, the nominal interest rate needs to go up by the same amount as the rate of inflation. So the answer is here that the nominal interest rate will rise by 3%. Each additional percent points of expected inflation drives up the nominal interest rate by 1 percent point. What will happen to the equilibrium quantity of loanable funds? So remember we're talking about quantity here, right? Not the price. So we saw that the price was the interest rate and that it went up by the same amount as the expected rate of inflation increase. But what happened to the equilibrium quantity of loans that were being transacted? They did not increase, right? They remained the same, right? That is what happened. So an expected change in the inflation rate will only affect the nominal interest rate by the same amount in order to keep the real interest rate at the same level and do nothing to the quantity of loanable funds transacted. That's what the Fisher effect tells us. And that is what actually happens based on what we saw with the movement of the inflation rate and the nominal interest rate. So again, the loanable funds market is a hypothetical market that illustrates the market outcome of the demand for funds generated by borrowers and the supply of funds provided by lenders. Again, you've got the price, you've got the quantity. The price is the interest rate. You've got the downward sloping demand. You've got the upward sloping supply. They set an equilibrium interest rate and an equilibrium quantity of transacted loans. So we're going to have a shift of the demand for loanable funds. The change in perceived business opportunities is one thing that can shift it. The change in government spending is another thing that can shift it. And another thing that can shift it is also an expectation of inflation. So we expect inflation to go up. So the demand curve shifts to the right. And then you've got the shifts of the supply for loanable funds. Generally, you'll have changes in private saving behavior that will shift the supply for loanable funds. Changes in net capital inflows will do the same. Net capital inflows is the total inflow of funds into a country minus the total outflow of funds out of a country. And so if we expect inflation to go up, then supply will shift to the left, and it will shift as much as is necessary in order to equilibrate the market at the same quantity of loans. So the interest rate will go up by the expected increase of inflation by 3%, by both the supply and the demand shifting, which will then keep us at the same equilibrium quantity of loans. So what will happen to the equilibrium quantity of loans? The equilibrium quantity of loanable funds is unchanged. As long as inflation is expected, it does not affect the equilibrium quantity of loanable funds. Both the supply and demand curves for loanable funds are pushed upward, leaving the equilibrium quantity of loanable funds unchanged. Practice short answer question. All right, folks, we are done with this chapter. Good job. So I opened up the homework for this already.